So we have discussed some part of these slides. Beginning part we have discussed already. Now we start from where we have stopped. So we have already discussed introduction part and of the conceptual framework, and then we move to general purpose financial reporting. It was the second part of the presentation, and we have discussed these stuffs. Yes, we have discussed this slide at last. Now we will discuss about accrual accounting. So financial performance reflected by uh, accrual accounting. You know, what do you mean by accrual accounting? From the beginning you have studied well the differences between accrual accounting and cash accounting. In simple term, we can say in cash accounting, we record only the cash transactions, cash received and cash paid. But in case of accrual accounting, so accrual accounting concept is the one of the basic assumption, basic principle of accounting. Whenever the transaction has occurred, we have to record it. We don't want to wait until we receive or pay the cash, right? So therefore, it includes cash receivable and cash payable, and right, cash payable and cash receivable also we can find in accrual based accounting. Here, accrual accounting depicts, accrual accounting shows, accrual accounting explains the financial performance in the period. In the period, normally we take 12 months. The period through cash receipts and cash payments occur in different period. Right? Cash receipt and payment occurs in different period. For example, our accounting period start from 1st of January 2021 to 31st December 2021. This is our accounting period. For cash accounting, we consider only the amount of cash received and amount of cash paid during these 2 dates, that cash accounting. We not consider the cash payment or cash receipt beyond that period. So in cash accounting, we are not taken into consider cash receipt or paid before 1st of January 2021, and also we are not consider any case receipt or case payment after 31st December 2021. We are not consider. But in accrual accounting, even though a cash receipt or payment made before or after the accounting period, but these payment or receipts are related to our accounting period, that time we have to take into consider. So therefore, we have to make adjustment for cash receivable and cash payable. Cash paid in advance, cash received in advance. Cash payable at cash paid at advance paid at end of accounting period, or advance amount received at end of the period. So we have sort of adjustments, opening balances and closing balances we can find in accrual accounting. But in case accounting, we couldn't find opening balances and closing balances for income and expenses. That is a basic concept in basic ideology in accrual accounting. So accrual accounting depicts the financial performance in the period through cash receipt and cash payment occur in different periods. So it provides a better basis. The accrual accounting system is better than cash accounting. So the accrual accounting, right, it provides a better basis for assessing the entity's past and future performance. So in cash accounting, it's very difficult. It's not give us a meaningful information about entities' states of affairs. So accrual accounting, it's the correct accrual accounting reports the events it was happened at particular period of time. But cash accounting, it doesn't consider the event has occurred. Rather, it focus on the day that the case transaction has made. So, for example, the big amount of sales, say 10 million sales, additional sales has done in 2020, but we have received cash 2021. So based on the cash accounting, it shows the company has made sales 2021 in cash accounting. But when actually speaking, the cash transaction, the sales was made in 2020. So therefore, that 20 million sales is a performance of company's performance. So accrual accounting is clearly explained as it was the performance relevant to the period of 2020, not for the year 2021. So it gives a good basis, so it provides a better basis for assessing the entity's past and future performance. Based on not only the past performance, based on the information provided in the financial statement, which are prepared based on the accrual basis, we can use that information to predict the future also. So it better explains an entity's capacity for generating net cash inflows through its operations. Right? Generating net cash inflow means ability to making profit. If companies make more profit, it will generate more cash. That cash is belongs to the owners, the shareholders, right? So that cash, if the profit are not distributed among shareholders or the owners, that cash will be available in the firm, within the entity, for making new investments, or it increases capital reserves, retained earning. So therefore it appreciates the capital, it increases the capital balance, equity balances. So it's better explain entity's capacity for generating net cash inflows through its operations than obtaining additional resources directly from investors and creditors. Companies can get more equity in two ways. The one way is they can get capital from owners, equity capital from owners, from shareholders. The second way is making profit. So the company grows in two ways. Either one way is by making profit. The second way is by getting more equity capital from shareholders. And also the cash balance increase in third method by using credit. Neither profit nor equity, rather they can get a bank loan or other credits, and also this time the cash balance will increase. But our focus is on company's performance. So information about a reporting entity's financial performance during a period can also help the users to assess management stewardship of entity's economic resources. As I explained to you earlier, stewardship means is a kind of behavior of management, it's attitude of management, so that they work hard for the betterment of the shareholders. They are not selfish. if we notice this kind of behavior, right, the management behaviors are towards for the betterment of uh, shareholders' wealth. So this time we call it stewardship. And for in contrast, for stewardship, we can call as agency cost. Agency cost mean the managers are work for their personal development, not on behalf of their shareholders. So that's a the bad thing. So managers are abusing the shareholders' wealth. The stewardship is a good thing. Stewardship means the behaviors, kind of behavior towards maximizing shareholders' wealth. So based on their accrual accounting system, it can be used as a good measure to assess the stewardship behavior of management. So the shareholders given the economic resources, and they can assess how their managers are using the entity's economic resources. You know, so entity's economic resources belongs to the shareholders. The owners are the shareholders. So stewardship, the managers are the agents. So the employee managers are the employees. So these employees should utilize the owners' resources, economic resources, for the betterment of shareholders, not for their personal benefit. And it helps understand the impact of events. Accrual accounting reflects uh, reflects events for a particular period. But cash basis accounting, it not reflects the exact impact of that event. So it helps understand impact of events such as changes in market price, interest rate on entities' ability to generate a net cash inflows. Right? Sometime, in economic conditions, we can observe favorable economic condition and unfavorable economic condition. So COVID-19. So COVID-19 is a pandemic. It is for most of the enterprises, organization, entities, it's negative. It's a badly impact for most of the sectors, most of the entities. But for some sectors, it gives a positive signals. It makes uh, more opportunities. We can say, for example, mobile data subscribers, right? Internet service providers. Now they are. It's COVID pandemic. It's a good time for them. They can develop. They can observe. They can realize an extraordinary performance, because the government has introduced, not only government, most of the organizations are introduced work from home policy. So therefore many people are compelled to use their services, the telecommunication sector services, the internet provider services. Therefore it has increased. So this kind of events, this kind of macroeconomic conditions, demographic conditions reflect on their financial statements, right? And also if any changes in interest rate, tax rate, so that also will reflect uh, on the income statement, and it's mean the financial statement. So it is possible this kind of informations, decisions, timely decision possible when the companies follows the accrual based accounting system. Past cash flows. You know about the cash flow statement. Cash flow statements explains you how the company, how the entity generate money, and how the entity spend their money. So what is the company's performance through its operations, how it creates, how it generates money. And there are other ways also generating money. So investment activities. So by selling uh, investment assets, by selling capital assets, they also can get money. And also the financing activities, and we can find how much equity has issued, how much debt or debentures has issued to uh, generate money. So financial performance reflected by past cash flows. So mainly it focus on cash flow statement, and which one, the accrual accounting system, it's mainly focus on income statement. Right. So past cash flow statement, right? So information about information about reporting entity. Reporting entity means our entity. So if you're an accountant for XYZ company, that XYZ company is a reporting entity. Information about reporting entities cash flows during a period also help users. Now, when you take the cash flow statement, we can assess, right? The cash flow statement uh, help you to assess the entity's ability to generate future net cash inflows. Right? By looking at the cash flow statement, you can assess the firm's future ability to generate future cash flows, future cash inflows especially, and to assess management stewardship of the entity's economic resources. In the cash flow statement, we can easily find how a company has generated cash. That cash actually is a profit. This profit and cashes are belongs to shareholders. Now, the managers try to abuse the profit for their self or personal benefit. So, and all, not only how the cash is generated, and also it explains how the cash is spent, how the generated cash is used in the entities. So by assessing the how the money, how the cash, or how the profit has utilized by the management. So based on that assessment, the users can assess the management stewardship attitudes, the manager's attitude to assess management's stewardship of the entity's economic resources. So that information indicates how the reporting entity obtains and spends cash, including information about its borrowing, repayment of debt, cash dividend, or other cash distributions to investors, and other factors that may affect the entity's liquidity or solvency. So not only how company generate money, so it also gives information about how entity obtains, or how firm receive money, how firm spend money. So that's common, but in detail it gives information about how much it takes money from borrowing, how the company spend money by way of repayment of loans, and if the money if how the profit is distributed among shareholders as dividend, and cash distribution in the way of equity share splits and bonus shares, like that, to investors, and other factors that may affect entities liquidity or solvency. Information about a company is information about cash flows help users understand reporting entities operations. evaluates its financing, investing activities, assesses its liquidity or solvency, and interpret the other informations about financial performance. Economic changes in economic resources and clients. Now, economic resources and clients mean economic resources, in particular, they are focusing on assets, fixed assets and current assets. The changes in economic resources, it's mean changes in economic assets, and clients focus especially liabilities. So changes not resulting from a financial performance. So normally, when companies are not getting loan or other further equities, the cash increment is due to company's financial performance. So other than the company's financial performance, how can they generate money? How can they get money? How can they increase the level of equity or cash balance? Only two options it has. On one option is cash received from equity shareholders, or they can get loan. So other way also is there, so they can sell their fixed assets. Reporting entities, economic resources, assets, and claims, liabilities may also be changed for reasons other than financial performance, such as issuing debt equity instruments. Information about this type of changes is necessary to give users a complete understanding of why reporting entities, economic resources, and clients changed, and the implication of those changes for its future financial performance. The case follow statement is very important to get clear understanding about complete understanding about company's performance, entities performance. The reporting entities, economic resources, and clients changed, and the implication of these changes for its future financial performance. Information about use of the entity's economic resources. So this one, changes in economic resources and clients. So it's focused on balance sheet, statement of financial position. So this slide, past cash flows, it's about a cash flow statement, and accrual accounting. These slides explains you to give more information about income statement, statement of financial performance. Information about use of entities' economic resources. Economic resources mean its assets. Use of entities' economic resources, its assets. Information about how efficiently and effectively the reporting entities management has discharged its responsibilities to use the entities' economic resources. The shareholders, the owners, given all their assets, fixed asset, machineries, plant, everything, money, everything they have given to managers. All of these are economic resources. So management will take responsibility to use effectively and efficiently for the purpose of achieving the shareholders' goal. So by looking at the balance sheet information, especially asset side, so the users, it helps to users to assess management stewardship of those resources. Okay? Users can assess management stewardship of those resources, whether the management abuse the resources for their self-benefit, or whether they properly use the resources for the attainment of shareholders' wealth. And also it it can measure how efficient the management is. And also this information helps to users to predict how efficiently and effectively management will use the entity's economic resources in the future period. How the economic resources has been used in the past, in the present and the past. Based on that information, users can predict the behavior of management in the future. Hence, to assess the entity's prospect for the future net cash inflows. So based on this information, they can assess whether the entity will generate more profit in the future or not. For example, example of management responsibilities. Management responsibilities to use the entity's economic resources include. So what are the responsibilities of management regards to its assets, its resources? What are the responsibilities? For example, we can see protecting those resources from unfavorable effect of economic factor such as price and technological change. Best example is COVID-19 pandemic. Here, everybody knows the COVID-19 pandemic will adversely impact on companies' performance. During this pandemic, the managers has responsibility to safeguard the entity, safeguard the business assets from this pandemic. The management should take necessary steps to protect their resources due to the changes in the interest rate, government policy, or some natural disaster. So this kind of incidents, circumstances, the management should take responsibility to safeguard their resources. So this is the example of responsibility, example for responsibility, and ensures that the entity complies with applicable laws, regulations, and contractual provisions. When the company is doing their business operations, they have to comply with different laws and regulation of the country. Especially they have to they have to comply with employment law, consumer production law, right? And the EPF, ETF kind of stuffs, and there are a lot of laws. And if it is a company, they have to comply with Companies Act. When they pay income tax, they have comply with Inland Revenue Act, this kind of stuff, right? So they have to ensure that the entity complies with applicable laws, regulations, and contractual provisions. Now we'll discuss about the general purpose financial reporting and its limitations. Limitations of general purpose financial reporting. Now, what is general purpose financial reporting? Very simple. So normally the companies publish their financial statement in the annual report, sometime in the newspaper. Finance companies, or especially banks, will advertise their financial statement in the newspaper most of the time. So general purpose financial statement is normally what we prepare as a statement of income, statement of financial performance, statement of financial position, cash flow statement, and changes in equity, notes. These are the general purpose financial reporting. So you can observe a certain type of information. You are unable to take information about what are the items they have sold, what are the cost of each item, how many employees are working there, what technologies are using there. So this kind of information you are unable to get from their general purpose financial statement. This is the common thing. So general purpose financial reports do not and cannot provide all of the information that primary users needs. So primary users mean investors, shareholders. So they may require different informations. How many employees, how many male employees, how many female employees, then how many hours each employees are working, how much each employees are getting salary. This kind of informations are not available for that investors or primary users. And general purpose financial reports are not designed to show the value of the reporting entity. So it shows the book value. You can find the book value of the entity. If you want to see the market value of the firm, what we can do? Simple, it's simple. You can get the market price of the share, market price into number of equity shares, number of shares. Then you can get the market value of the firm. But that kind of information is not available in the general purpose financial reporting. Individual primary users have different and possibly conflicting information needs and desires. When we consider about a company, it has a lot of investors, thousands of investors, thousands of dispersed investors. So everybody needs a different type of informations. One person may need how much, what are the type of inventories you have, companies have. So another investor need information about what are the items the companies are selling. So what is the color of the car? What's the registration number of the car? What car is used by managers? So this kind of informations are not available in the general purpose financial reports. To a large extent, financial reports are based on estimates, judgments, and models rather than exact depictions. Now, when you take the balance sheet, you can find another property, plant, equipments. Everything's are estimated amounts, not actual amount. When you get the information about actual amount, so for example, a company has a machine. We can find information about the machine in the financial reporting is what? Its book value, accumulated depreciation, and carrying value. That sort of information we can observe in the general purpose financial statement. But if you want to know the actual value, you can take at the time of sale. At the time of sale of the machine, we can get the actual value. And provision for bad debt, it's estimation. Accumulated depreciation, it's an estimation. Provision for doubtful debt, provision for bad debt, right? So this kind of stuffs are judgments. Goodwill, it's a judgment, it's estimations. General reserves, estimations, right? So to the large extent, financial reports are based on estimates, judgments, and models rather than exact depiction. So that's all about that presentation.